Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week, as well as longer-term trends from a technical perspective. Take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, January 11th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with look at what the market's been doing this past week with a look at the market letter.
Okay, well, last week we started out the week with the last 2 days of the Santa rally, which was okay this year. It kind of lived up to its name, and we kind of fell off out of bounds a little bit. But investors started the week. They were optimistic that probably the worst of the Omicron variant was kind of behind us. However, when the FOMC meeting minutes came out on Wednesday, the Federal Reserve kind of surprised the market a little bit. Their tone was a bit more hawkish than what was expected, talking about the rate hikes and that they may want to trim down the balance sheet, and also that they wanted to speed up a little bit more aggressively their asset tapering. So that surprised the market. We had we sold off pretty hard. The market doesn't like to be surprised. They were kind of hoping that we were just going to go on with the kind of the same kind of talk that we'll get there. Things are going to be slow, but they talked about that they took out transitory out of the inflation talk, and then they started talking that we're probably going to have at least 3 rate hikes. And even yesterday, I think Goldman Sachs and JP Morgan said they think that maybe we'll have 4 rate hikes next year. We've talked before in the past about how it isn't necessarily where the rates end up. It's kind of the ascent of the rates as they start to move up. If you go from 1 to 2, that's not a big move as far as where the rates are going to go. But it's actually when you start thinking, well, that's double what the rate was 30 days or 90 days ago, then that starts to affect the market and starts to affect the short-term business propositions that they make. The NASDAQ was started out strong. In fact, on that Monday after the holiday, we came up. The NASDAQ spiked something like, let's see here, it was up something like 3%. We had big gains in Tesla. That helped the NASDAQ. The Tesla was up, I think, 13% in one day, just because their deliveries were up 71% year over year. We had Apple at the start of the week topped the $3 trillion market cap. That was big. We had gains basically led the market. We're in energy, industrials, and banking. That helped lift the Dow to a new high on Tuesday. But the NASDAQ had started to, was kind of the sell the rally there going out towards the end of Tuesday. And we saw a lot of the big cap technology names start to pull back at that stage just before the minutes came out on Wednesday. They didn't want to be surprised. Maybe some people knew some things. But anyway, that's where we started to see the market pull back. The technology obviously took the brunt of the selling. I think the NASDAQ was down 3.34% on that Wednesday afternoon or Thursday. That was the biggest percentage loss the NASDAQ had since February of last year. So it was tough. We went down. We started to bounce around the 50-day moving average. We saw investors just get a bit more aggressively move out of technology and into the cyclical old economy stocks. Energy, which had been, I think it was up 10.5% during the week. It was flirting with $80 a barrel. Again, as rates start to go up, these cyclical names are going to outperform. And we started looking more as the demand's probably going to be, even higher on energy as the economy starts to build out here. And the reason rates are going up is because this economy is strong. So as we talked a little bit about that, we started getting a steepening yield curve. Financials gained 5.43% last week. So energy and financials are still the places that we're seeing the market go into. Now, today we'll talk a little bit about what's going on today, but the industrial sector also outperformed. It was close to an all-time high. That's the XLI. And then conversely, we actually saw some of the defensive sectors, rate-sensitive sectors like REITs and even utilities, consumer staples. They were kind of weakening. They had started to pick up some pretty good strength going in there, as it looked like maybe perhaps toward the end of last year that maybe they weren't going to be raising rates and that the Omicron was going to actually slow the economy down, but that didn't seem to be happen. So we had losses last week in technology and healthcare. They were both down about 4%. The yields moved higher. They were actually about their highest level since March 2021 when we started to had a nice tick up there before the market rolled over a little bit. The 30-year bill, T-bill closed at around 211. That's pulled back a little bit today. We'll get into that. 10-year yield was at 177. It topped 180, I think, possibly yesterday early, but it's also pulled back a little bit. We had a disappointing jobs report on Friday. That kept pressure on the market also ahead of the weekend. And then, so basically the Dow was almost flat. I mean, it was down about 100 points, but the NASDAQ, it was down 4.5%. Small cap Russell 2000, it was down 2.9%. The S&P was down almost 2%, 1.9%. So, in general, just a rough start to the new year. Now, the technical condition of the market did deteriorate during the week. Despite the Dow Jones and S&P 500 hitting new highs, Monday and Tuesday, the technical indicators weren't confirming those new highs. They were shifting more to a negative slant. MACD was negative or bearish for the different indexes. Momentum pretty much had moved from neutral to negative for most of the averages. New highs recorded by the Dow and S&P 500 just weren't confirmed. When we say is it confirmed, you'd like to see, especially the 14-day RSI, also making a new high as the indexes do. If it doesn't quite make the new high, that's called an unconfirmed new high. And that's what we had last week. Now we had the NASDAQ last week closed down below its 100-day moving average. The Russell 2000 finished the week below its 100 and 200-day moving average. But the indexes did hold briefly above the December lows at that time. And we mentioned on Friday in the letter that if those levels, the December lows, didn't hold, then we would probably see the NASDAQ go down and test its 200-day moving average. And that's what we got yesterday. The 200-day moving average came in around 14,680. And it's hard to stop right on those numbers, but the NASDAQ actually went down to about 14.6, something like that, and then it actually came back up and bounced and was able to close much higher off that. All of these, if you look at the charts, let's go ahead and go to the charts for a minute. Okay, go ahead and pull up this. Let me pull up the NASDAQ first, the COMP. Okay, as you can see on this, I'm going to pull it up over here so I can see a little bit better on my computer. Okay, but you can see over here yesterday, where we had the NASDAQ fall below the 200-day moving average. Will, can you make that into a candlestick chart? There you go. Okay, so that just shows you had a long wick hanging down below the NASDAQ. It did fall down below the 200-day moving average, and then it actually finished up on the day, not by much, but it was. That's pretty much. This is a little not quite as good as what we'll see on the S&P 500, but some people would consider this a little bit of a hammer pattern, which is usually looked at as reversal. Go to the S&P 500 now. Okay, now this candlestick pattern is almost textbook, where you've had a couple of days of selling, and you see the market opens up, not too far down, but then it just drops. Sometime during the day, you have a long wick coming out of the body of the candle at the top, and then you actually finish up a little bit higher. So I mentioned yesterday in the daily letter that was a reversal pattern, bullish reversal pattern for the candlestick, and that probably would mean that we could probably very easily see a bit of a rally today, which we've gotten. The Dow Jones also had a hammer yesterday in its pattern, and it actually came back above the I think it's 50-day moving average. So not only did you have this bullish reversal candlestick, but you also were able to come back up and clear today, especially some of these resistance areas that were that we had broken down over the last couple series here. Okay, so anyway, today we got the Chair Powell has testimony before Congress for his reconfirmation hearing, and he if you got to watch it, he had a much softer tone than what they had in the minutes on last Wednesday. And as you can see, the NASDAQ now, it was up about 185 points as we started to go into this. It's rallied almost 500 points from yesterday's low. So that's a strong reversal. And again, when you see a pattern like that in the chart that you see on the S&P 500, and this is hammer reversal patterns, that's something to take note of, because usually they're pretty good for traders that will follow candlestick trading. So anyway, momentum is improved, with this thing. Something else I'd like to take a look at. We'll pull up UUP on the chart. This is something I haven't been talking about, but it's something you may want to take a look at. This is a kind of an ETF for the dollar, and it actually today is lower again. And this is a chart that looks kind of heavy. A strong dollar also was going to weigh on the market and also on commodities. Now today, with this softer tone, we're seeing the dollar actually come down and break below the 50-day moving average. I think you're going to see the dollar now that he's, especially maybe even if the inflation numbers back off a little bit, you'll see the dollar come down a little bit lower. And that would also help commodity prices, which that's why we've been talking about that VALE last week and some of these other commodity trades that are working out well. You're seeing a pretty nice move in those the last couple of days. And again, that's part of that is because the dollar is coming down. So this is something to keep an eye on too. Just the fact that we broke the 50-day moving average means that we could see the dollar weaken here. That will help, firm prices for the major averages a little bit below that. But keep an eye on that. Another thing that we wanted to look at, go ahead and pull the NASDAQ up one more time, Will. Okay, here's another thing you can watch. Do you have the honest 14-day RSI up? Okay, you do. Okay, here's something that you'll see a lot of traders look at, and that is when you have a sell-off like what we have, like say in the NASDAQ and some of the other indexes. Not only is the 14-day RSI used as a overbought and oversold indicator, it can also be used as a trend identifier, where when you have pullbacks, you want to see the 14-day RSI, not break. You'd like ideally not to break 40, below 40. If it breaks down to 40, yesterday we'd have seen the 14-day RSI on the NASDAQ break down into say 32 or something like that. I think it got down yesterday about 38 at the low, and now we're back up in the 40s with today's action. If that stays above 40, it's usually a good sign for traders that the bull trend is still intact. On the flip side, when you see the market that's been on a downtrend, and all of a sudden you start to see it turn around, and the RSI goes up to about 60, maybe about 60. If it gets up above 60, then you probably have you're starting a bullish trend again. But that's where you would expect it to die out. Just as in this case, you would expect that this thing's going to keep going higher for a little bit. You would expect the 14-day RSI to bottom around 40. But anyway, that's some things to look at. And like I say, we are getting a nice healthy rally today. We're getting a nice bounce in the technology shares that have just been pummeled. I think the XLK I mentioned yesterday was down about 8.8% off of its high, the XLK, just from a couple weeks ago. So it almost went into correction territory, but it came up short, and we're getting a nice bounce in that today. But still, leading this turnaround has been more money going into the energy and financial sectors and some of the industrials, old school type of stocks.
All right. So last week we talked about energy and financial shares taking the lead from high-flying tech shares, and that investors should be overweight in these sectors as the Fed reduces asset purchases and rates rise to fight inflation. You mentioned Chevron and Schwab as two stocks to look at. Both being market edge buys, and they're both making new highs today. Later this week, we got Q4 earnings from the big money center banks. Should investors jump in here ahead of the actual earnings report?
Well, let's go back, just step back a little bit. Go ahead and you can pull up XLE on the chart. Okay, so now you see, you want to. There's always a bull market somewhere. So now you look at the XLE. Despite all this weakness in the broader market, this thing came down towards the end of in December. There bounced off the 200-day, and now we're out here making new highs. It's making new highs again today. Go ahead and pull up the XLF. And you can see the same thing. We're making new highs on this again today. Now, one of the things you can do if you when you look at these sector ETFs, it's basically going to tell you where everything is going. If you look at the bottom of the XLF, you see all the green signals that it's generating here over the last 2 or 3 weeks. That means that this thing is busting out technically, and you want to be in that when you see those things these technical signals being delivered like that. XLE is the same way. But go right now to the industry group analysis for a minute. Okay, now click on 1 week percent change. Do it twice so we get the ones that are the strongest in here. Okay, so we have aluminum in here. Again, that's more of a commodity type of stock. Over the last 1 week and 4 weeks, it's up 9 and 11%. So you're seeing a lot of that going to the commodity, the trade like we were just talking about. But then you also see in the last week casinos, other recreation, lodging, and airlines starting to turn around also. They had a good week, and that's basically because the feeling around in the market basically is that we're closer to the end of the Omicron pandemic than we are, at the beginning. That can always change, but that's starting to see. You're starting to see money flow back into these casinos and thinking, okay, well maybe the market looks out about 6 months. That means as we get closer to summer, people are going to be ready to travel, and they'll be traveling beforehand. So you want to be in those also. But a little bit further down in here, you'll see, let's see here, go on down the page, and all of a sudden we'll see oil field drilling, and we'll see oil field integrated majors, okay? Now, these stocks have underperformed the market for about the last 4 or 5 years. But if you click on, we have oil field drilling here. Click on that, and you're going to see a couple stocks where you can see the MarketEdge is now upgraded 1, 2, 3, 4, 5, 6 of these stocks in here. Halliburton is one I'm pretty familiar with. Another one would be Schlumberger. But any of these that are, have been upgraded to a neutral are ones you may want to take a look at the chart and possibly be ones that you can buy here. Click on Halliburton. Well, up there in the top, okay. You can see yesterday it struggled. But today, we don't have today's action in here. But today Halliburton is up. It's up at 27.05. So you're up 4.6% in just today. That's because you're getting another spike in the oil prices. You're getting more money's flowing back into energy. Click up on the chart. Well, actually, I'm just on the second opinion. Put in SLB. Okay, this is one of the oil field equipment and services. It's a Schlumberger. Again, here's another one that was just upgraded yesterday to a neutral. And you're going to see this thing upgraded. Today it's up 36.46. So we're up 3.8% today on that one. So these are some of these stocks that you're looking at now, and you think, well, they've been talking about energy going for a while. These things are still breaking out. They're making new highs, and they've got a long way to go before you start to see these stocks, slow down. You're going to see more demand, for oil prices. And the best thing when you're looking at some of these things, they just haven't moved. They've moved over the last month or so. But these are stocks that you may want to own. Now go ahead. Now go over back to industry group. Maybe on this case, you may want to go down to the bottom there, and you can pull up 40. So you show at least the top 40 things here, and then again click on the 1 week percent change. Here you can go down there and you'll see oil field integrated majors. Go ahead and click on that. Okay, we talked about Chevron last week, CVX, and we have it rated long. ExxonMobil, we had that rated long. You go ahead and go to the chart on Chevron. I preferred that one before, but I think Exxon may probably play some catch up here. Okay, so you can see Chevron moving up here. Just in the last week, we had quite a move. It's making new highs. But let's see, CVX is up today. Okay, it's up another 2.14% today. It had a high today of 128. So again, money's going into that. You can go to the smart chart if you want to, and you'll see that these. So I think Chevron's a little bit overbought. With today's action, I think the 14-day RSI is up in the 70s on that one. Exxon, like I say, Exxon may play a little catch-up ball here. Yeah, actually, Chevron is at 77.85 on the 14-day RSI today. So it is a little bit overbought, but I would buy on any kind of weakness in that. So, when you're starting to see some of these people talking about rotations, including me or on TV or whatever, and you can go to this industry group, click on those. Go ahead and go to the industry group again, Will. Okay, and if you click on that 1 week, click on there once or twice, you can see the leaders over the last week and 4 weeks, and that shows you how fast some of these things start to move. When they rotate into these industry groups or sectors, you're going to see a lot of money going into. That's not mom and pop buying aluminum casinos right in here that move those stocks 6%. That's institutional money and the hedge funds going in there, and that way you're joining them. By the time these things get upgraded and start showing a positive trend again, these things could be up 15-20%. So if you watch something when you're talking about the rotations of in and out of different things, you can go into the industry group analysis and click on the 1 week and 4% changes and see what's really moving. Because even though some of these are rated weak, because it'll still counterproductive. They'll go in there and say, okay, they were weak over the last 50 days. However, the last week or the last 30 days, this thing's really starting to turn around, and that's where you'll find some ideas. Okay, as far as the financials go, you mentioned that, and last week we did talk about Schwab for a while. I mentioned TD Ameritrade as these online stocks, and go ahead and go back to the charts. We'll take a look at Schwab, SCHW. And you can see Schwab, making a new high. And I mentioned, and this is from when we used to go around and talk to the guys at Schwab and TD Ameritrade back in the early days when we were just building up business. Today, Schwab's up another 2%. It's at 93.65. And they were always talking when rates start to rise, every quarter point brings in tens of millions of dollars more in profit because of the spread to these companies. So they don't have all the branches that some of the other stocks do. I looked at this earlier. This might be one that we have. It's up $1.40 today, so it's at 105.50. So you have Morgan Stanley starting to break out to new highs. And this is one that, if you look at the sideways action that it's had since August, this is probably one that it is one that I actually own. And I think that Morgan Stanley will probably outperform some of the other big stocks. Now, one thing I just want to mention, we talked about the big banks starting to come out here in at the end of the week with their Q4 earnings. And historically, this is just from being in the market for quite a while. When you see these stocks, let's pull up WFC. We wish we had bought this at 48. We're at 55.81 today. But when you see these stocks jump up like this, this is not the days you want to buy them. When it broke out at 52, maybe you could have bought that day. But they're expecting Wells Fargo and Citigroup, Bank of America to really generate some strong earnings. On this report coming out at the end of the week. But historically, when these stocks have had a big run up into the earnings, you will see them sell off over the next day or two. And I think that some of these stocks, they should be. If you don't own them, it's probably a good time to buy. They're still cheap. They're trading. Let me see. I think that's J.P. Morgan. J.P. Morgan's another one. They always have a good thing. And these things are trading at PEs of 8 and 9 times earnings. Or when you talk about some of the tech and industrials trading at 35, 40, 45 times earnings in a rising rate environment. I don't want to have a rising rate. Usually you're going to have a contraction of multiples. Well, I think if we're going to contract in the multiples, I think I'd rather own something that has a 8 or 9 or 10 time earnings rather than something that's 35 or 40 times earnings. So watch these stocks: J.P. Morgan, WFC, Wells Fargo, Bank of America, BAC, even Citigroup. Pull Citigroup up. Well, just see. Okay, Citigroup hasn't even made it back to where it was in the fall. So it's had a nice move here from about 59.60 up to about 66. It's had a nice 10% move going up into earnings. It's kind of stalling out up here around its 100-day moving average. Maybe if the market keeps going here the next day or two, maybe you see the thing get up around 68 or so. But then you might have a chance to see it pull back a couple bucks. And if you're looking for dividends, I think that's around 2.5%, 2.6%. But this is telling you the market is expecting good things out of the banks, and they should. With the rates starting to widen, the yield curve starting to widen, they should have that. They're going to be probably low on fees, and you kind of want to watch to see how loan growth is. Loan growth with the Omicron may have slowed. That may be something that they don't like or whatever. But I think that rather than buy ahead of earnings, you want to wait on these stocks until they go. Now, another one you could look at is KRE. This is an ETF, and it's the S&P regional banks. Again, these are all rated, by second opinion. And this is also KRE's gone from 66 up to 77, so it's up 10 to 12%. But if loan growth starts to improve, here as we get into, I think probably more in the second half of the year, as we see the Omicron get behind us and we start to see the economy start to pick up again. This is paying about 2+% dividend. You're going to have exposure to all the different banks, so it's going to be less volatile than what you have. But this breakout here that you're seeing recently is taking out the November highs, and it's got a ways to go too. I think it's definitely underperformed the broader market. You can see right here with that ETF doesn't have a PE ratio at this time, but again, it's up 2%, and I think that could be one that you want to look at going forward. Now, one thing I wanted to mention, because everyone's talking about okay, we're going to have 3 rate hikes, 4 rate hikes, and how's the market going to handle that? One thing, and we saw a little bit of it today, where you saw Fed Chair Powell kind of soften his tone with the with the rising rates, and other presidents are trying to grab the headlines. They want to talk about reducing the balance sheet. They're not about to upset this market, I don't think, because despite their mandate to basically just prevent inflation from setting in, they don't want to upset a stock market. Now, they didn't. We saw what it did. It may have been painful just here when they started mentioning that they're going to start to raise rates a little bit more aggressively. Rates are still low, but this wasn't much of a correction. I mean, you had 5, 6, 7% in there. Okay, now we're bouncing back fairly rapidly, not to new highs, but we are bouncing back. The Fed that's not enough possibly for them to, they may still be kind of a little bit soft on that, but I don't think they'll. And they could still, be a little bit aggressive in here and not kill the market, because we were still talking, rates at 0.5%, 3/4, maybe 1%. It's not going to kill everything. Another thing to remind you of is historically, in the second year of the president's full term, that's usually when the stock market is going to outperform. So you want to keep that in mind. They're probably going to have a little bit of pressure that they don't want the Fed to ruin the market during this Biden's year of this. Part of that is probably because this is the year when Biden needs to get something done while he has a chance, because starting the third year, that's when he's kind of working on trying to get everybody, Democrats, elected at the next election, and the following year he's trying to get elected. So they don't get much done on that. This is the year when they're going to try to do something, and that's why historically you'll see the second year of the presidential cycle be the strongest. So I don't think that you're going to see as aggressive rate hike as some people are talking. Obviously I'm not an economist, but I just think that once we get the Omicron past us a little bit, you'll start to see the supply chain issues again broaden out a little bit. You see more people going to work, and maybe they back off of maybe inflation starts to come down a little bit from there, mid-year, and they can soften their approach to raising the rates any faster. So at this stage, our CTI is still positive. I think maybe we can bounce off of this, but one thing I do want to note with the CTI is that is in a couple more weeks we are going to go negative on the market. I think as we get closer to the March time period, where I believe as of last week we were something like 75% or 78% chance of the odds at the CME Fed Watch that we were probably going to have the first rate hike in March. It was 78%, I think, last Friday. Perhaps the market gets a little bit antsy at that time. I think if they can come in there, they say they're going to pop rates now, and they may see what they're going to do the following month. With the next FOMC meeting, that could shake the market up a little bit when they're actually doing the hiking. Right now they're talking about it, and everyone expects them to do it, and they will. But don't just take it for granted that the rates are going straight up from here, as we've had some build up in the economy over the last the Trump years or stuff like that, and we still weren't able to get really aggressive inflation. So so it's very likely or very possible that we'll see inflationary numbers start to back off. Tomorrow and Thursday, I think we get the CPI and the PPI coming out, and another jobs report on Friday. Those will be numbers we're going to watch. Again, if you happen to see the CPI and PPI come in a little bit less aggressive or less inflationary is what they assumed, then Powell may have some more room to soften his approach even further, which could kind of keep the market from selling off too much in here. But right now, I think you get a little bit of a bounce here over the next week or so, and a little bit of sideways action. Probably for another couple of weeks until we start to get closer to the actual next FOMC meeting.
All right, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, email it in to support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.